Hi, everyone. Welcome to the kickoff of the 2021 PENTalk series. For our fifth season, we're starting off, as we do every year, with our installment on pensions, retirement, and markets, trends to watch in the new year. I'm Beth Parker with Pentegra. Thanks, as always, for tuning in. While folks are still logging in, I'm going to go over a few housekeeping items. We'd love to answer your questions, so please submit them through the question box. We'll answer as many as we can at the end while being respectful of your schedule and ending on time. If we don't get to your question, we will follow up. On your control panel is a handout section. Here, we've posted a copy of today's presentation. Feel free to download that now or at any point during the webinar. Let's get started. We're joined today by Fred Slade, Assistant Vice President and Senior Director of Investments for Pentegra. Since joining us in 2007, Fred has managed over $1 billion in internal bond portfolios, has provided case liability studies, analytics, and product strategy for our defined benefit and defined contribution plans. Fred got a start at the University of Pennsylvania, where he received his bachelor's degree, his master's degree, and his PhD in economics. As I like to say every year, I'm pleased to have the doctor in the house with us today. But this year, no question about the vaccine or COVID, because Fred is not that kind of doctor. Fred, thanks for hosting today. Let's get started.
Okay, thank you, Beth. I'd like to thank everyone calling in today, and I'd like to wish everyone a safe and healthy 2021. What I'd like to talk about today are what we might consider 5 key trends for 2021 in the pensions, retirements, and the financial markets. Oops. Okay, and that those trends include the stock market, interest rates and fixed income, the fiduciary standard, Secure Act, and Wall Street, Main Street. Let's first start with the U.S. stock market. 2020 was quite a year in the stock market. 2019 was a big year, returning 31.5%, but of course we had COVID, and once that spread in February and March, the S&P 500 index and the stock market in general had a record contraction, a record sell-off, and it dropped as much as 34% in March. Okay. However, starting in April and May, the market rallied significantly. And overall for 2020, the S&P 500 went up 18.4%. And this rally certainly surpassed Wall Street and, most expectations. And the U.S. market outperformed pretty much all international stock market returns. So although there was volatility, again, there was this huge rally after the huge drop in stock prices earlier. What were some of the major factors behind the 2020 turnaround? Well, first, you had record high stock valuations. Okay, what do we mean by that? We're really talking about how expensive stocks are compared to the company earnings. So we're talking about price to earnings, price to cash flow, and those were largely ignored by investors for some of the reasons that we'll talk about in a moment. But basically, no matter how high the price to earnings or how expensive many stocks got, especially the large ones, investors really shrug that off. Next would be general optimism regarding the COVID-19 vaccine distribution. Particularly going to 2021, when hopefully we'll have global immunity from the virus and allow the economies and activity to go back to something like pre-COVID levels. And actually, you almost could call the optimism hopes and dreams. I mean, hopefully this will all come about, but again, this very significant optimism regarding COVID. What would be another driver? Well, the Fed, in reaction to COVID, cut rates by 150 basis points, so a huge amount, to nearly zero in 2020, and provided trillions of dollars of support to the financial markets and businesses. So basically, the Fed rained a lot of money and a lot of liquidity into the financial markets. So that was a big factor in terms of creating an environment for the stock market to run up. And then Congress passed the CARES Act, as we know, the $2 trillion of stimulus in early 2020. And then in December, Congress passed another $900 billion of relief. Okay, so there was, in addition to the Federal Reserve, there was stimulus aid, and more stimulus is expected with the new administration in 2021. Numbers more in the 500 billion to 600 billion territory. Okay, so all these factors have sort of combined to provide sort of jet fuel, if you want to call it, for the run up in stock prices. And finally, something we haven't really seen in the past are commission-free retail investors. So you had a lot of people who normally didn't do a lot of trading in the stock market, going with E-Trade, Schwab, and an app called Robinhood, which you may have heard of. And these investors basically, I'll say, piled in, or certainly bought into to large tech stocks such as Apple, Facebook, and then, as you've read about, Tesla became a very hot stock. So basically, you had these investors who were not, who were basically saying, they're kind of going with the trend, and they believe that especially these large stocks, would continue to generate double-digit type of earnings, which actually Amazon and Apple, for example, have benefited from COVID and continue to run up higher than expected earnings, and so there was a sort of momentum that was aided and abetted, I guess, by these commission-free retail investors. Okay, well, what about 2021? Well, what are some potential caution signs? Okay, first is the economy. I mean, there was a bounce back in 2020 after reopenings came about, but we expect the fourth quarter of 2020 to show much slower growth. And then 2021, while we expect positive growth for the U.S. economy, we may only get back to 90%, or some people thought 95% of economic activity pre-COVID. There are, real optimists that think we might actually get back to normal by the end of 2021, but most people think that we're not going to get back to 100%. So that is something that could possibly factor into the stock market. Another caution would be interest rates. And interest rates could rise, especially in the longer end, like treasuries and and possibly corporate rates if there's inflation. And we've seen very, very little inflation, inflation being how quickly prices go up. But if the economic recovery and government spending creates price rise or inflation, that could then cause a pullback in stocks. Okay, so you want to keep an eye on that. But even if there is inflation, the Fed has said that they're not going to pull back their support unless inflation goes above 2%, and we really have yet to see that. Okay, fundamentals may start to play a more prominent role. We talked about that before. Very high valuation multiples, especially for the large cap stocks, but even the smaller stocks have come in with very high price to earnings and price to cash flow. So the valuation multiples, may at some point trigger some sort of pullback, but we really haven't seen that. We've really been waiting for at least 2 to 3 years now, for valuations to get back to more normal levels. Then going to, I mentioned corporate earnings, or if I didn't mention that, I'll just add corporate earnings have been flat to declining, but a large majority of companies have been beating Wall Street estimates. So even though corporate earnings have been flat or declining, they basically, they're beating these estimates, these analyst estimates, and that's kept the prices, certainly on an uptick or from declining very much. Other potential risk factors: congressional gridlock. Even though there will be one party controlling the branches of government, it's a very slim majority, so there could certainly be gridlock on things like the stimulus package. We still have geopolitical, what we call risks, with for example, Iran, North Korea, Brexit. The UK is finally embarking on Brexit, or I guess full-blown disassociation from the European Union. So there's certainly some risks there. Tariffs. We don't expect, or hopefully there will not be further tariff wars, but tariffs are still could be a factor. Okay, let's move to the second trend, or second theme, I should say. Is U.S. interest rates and fixed income. Interest rates fell to historical lows in 2020. Okay, driven by COVID-19, and then the recession in the first half of the year, and Federal Reserve, cutting interest rates, providing a lot of liquidity to the bond markets, and they're expected to stay low. If we look at short-term interest rates, less than 1 year maturity, the Fed cut rates by 150 basis points to nearly zero in 2020. And then the Fed has something called a zero interest rate policy, whereby interest rates could stay near zero for years. And also the Federal Reserve, as I mentioned before, will have more tolerance for inflation before even considering raising rates to slow down the economy. Intermediate and long term, if we talk about, like, say, 10-year treasuries, 30-year treasuries, the Fed has stabilized those yields at certainly low levels compared to the past. There's been relatively little day-to-day change, even though longer yields have begun to go up, an expectation of stimulus and recovery. But what's also important to note is that unlike a lot of other countries, and something that I'd written about last year, that there was some concern that when yields were cut, interest were cut, they might even go to zero or negative, but that doesn't look like it's going to happen. Also, just something on pension liabilities and funded ratios. Because of this lack of volatility and fairly stable rates, we would expect that there would be less volatility in liabilities. So funded ratios, any variation in that up or down will be more driven by assets than liabilities. Okay, just taking a quick look at CD rates, and that's something that still matters certainly to retirees on a fixed income. If you look, they were up around 1.2% average in 1 year, but then March, April was when the Fed cut rates by 150 basis points, and you see that at the end of the year, it's still above zero, but only around 0.4%. Okay, there you go. All right, the next topic or theme would be the fiduciary standard. And one could say that there was a move toward a uniform fiduciary standard in 2020, or at least getting something somewhere toward it. And there were sort of three major parties as far as the fiduciary standard. The SEC, Securities and Exchange Commission, after a lot of comment period, adopted its best interest or BI standards in 2019, basically requiring broker-dealers to disclose conflicts of interest and exercise reasonable diligence, care, and skill. The second, the other party, the next party would be the Department of Labor, or the DOL, and after their rule was struck down in 2018, they reissued their fiduciary rule in June 2020 to replace this with its best interest standard consistent with the SEC definition. So you saw some convergence, or at least some attempt to kind of merge as much as possible the standards. But then you also have the states, and the states have either proposed or implemented their own fiduciary regulations. New Jersey, New York, Connecticut being three of them. So they've gone ahead with their rules as well. So you kind of have this, have these sort of three roads here, and so it's moving towards some standardization, but it definitely has a ways to go. Okay, 2021, the SEC standards in place, its compliance date was June 30th, 2020. The DOL, there's a little wrinkle here because the effective date will be after January 20th. So that's after the inauguration, so the rule may be delayed in the new administration. So we'll have to keep an eye out on that. State fiduciary rules continue to move forward. Okay. Okay, I'm not going to go over point by point. This was actually something that this list I had talked about in last year's PENTalk, but it's really this, the same action items, the same reviews, and again, this is far from exhaustive, but these are all items that have to continue to be continue to be tracked, continue to be updated. Okay, let's move on to the fourth theme, or fourth trend, which would be Secure 2.0. And we've had a number of communications and webinars regarding the Secure Act, and Rich Rouser has posted a number of blogs and current thinking regarding this. So I'm just going to quickly, I'm not going to repeat too much here. But Secure, as we know, the original Secure Act was passed in end of 2019. Secure 2.0 was proposed on a bipartisan basis by the U.S. House in October 2020. Again, I won't repeat all the key provisions, but the RMD increased it from 70 to 75, increased catch-up contribution at age 60, loosens restrictions on what's called QLACs. That's something that had been at least one of the, I guess we might call impediments to 401k plans having in-plan lifetime, I'm sorry, lifetime income annuities. So that was this QLAC issue was something that had been sort of one of the impediments. Now that doesn't mean that we're going to have anytime soon. I don't think we're going to have a lot of plans adopting in-plan income options, but we'll have to see how that comes along. Okay, finally, I'm going to call Wall Street / Main Street. And generally what that discussion has been focused on is, number one, the stock bull market, certainly people holding stocks, again, there's been a lot of volatility, but there has been positive return, but that the feeling is it's generally benefited the wealthiest Americans, the largest stockholders, and there's what I call a disconnect between the stock market and the economy. So while the stock market overall has been doing pretty well, the economy has not. We've had a major recession last year. We're still not back to pre-COVID levels, and particularly the workers who have been hurt most by the COVID-19 pandemic, such as leisure restaurants, as we know. Basically, these people, a lot of them who don't have a large stake in the stock market. Another sort of Wall Street, Main Street thing is that there's belief among some people that there hasn't been enough attention and capital devoted to the global issues like climate change, income equality, and infrastructure. So how do we think about bridging the divide? Well, it's going to require the participation of government, pensions, and private sectors, because they are the sort of the decision makers in terms of funding and how much capital and money to devote to investments in these global issues. Second, additional stimulus. We've already gone over that. That's certainly something that's happened, and we will continue to see more of that. Keeping interest rates low, again, the least, people, that'll help house affordability, even though we know housing prices have been going up, but keeping interest rates low, but at the same time providing a positive return to people on a fixed income. Policymakers with Wall Street backgrounds, what that's really saying is that, people who are making, whether it's politicians or policymakers, making, decisions about, where to spend money and social policy and so on, having Wall Street background is something that is probably pretty much required in many cases in order to really leverage all the levers here. Okay, continuing the growth of ESG funds. Again, that comes back to the environment. Green funds. Funds that focus on looking at sort of what are the social costs of whether it's climate change or pollution, and investing in or continuing the growth of funds which will address those items. And then continuing the growth of infrastructure funds. I mean, everyone pretty much is in favor of infrastructure, but again, that's something that will again help bridge the divide between Wall Street and Main Street. Expanding retirement savings. Again, we talked about that. The CARES Act, and so that's really it. Lots on the plate for 2021. We're certainly hoping, in terms of recovery and immunity from COVID. And with that, so I'll put it back to Beth. If anyone has any questions, please go ahead and ask.
Great. Thank you so much, Fred, for giving us all that great information and insight. We do have a couple of questions that have come in to the question box. First, how will the 2020 U.S. election impact the capital market this year?
Hey, that's a very good question. As long as the Federal Reserve is injecting, all these trillions of dollars and keeping interest rates low, that should, bode well, for the stock market. Now, there certainly will be volatility, and most analysts are expecting, maybe 5 to 10% returns. Again, that's certainly nothing that we can be certain about at all. But so regardless of the election, as long as the Fed is doing what it's doing, overall, I don't expect sort of a major change. What may change is the stocks that are kind of leading the way or lagging. It was pretty much tech leading the way. But we may see, in 2021, with more stimulus spending and infrastructure, that we may see some shift away from technology to industrials and consumer goods. Okay, and another thing which might again cause some sort of slowdown, or I should say, in the tech sector, might be if there's more regulation and investigation of the big techs like Google and Facebook. Again, we expect interest rates to stay low, and so I wouldn't expect there to be, a huge overall impact, even though the stocks that sort of stock leadership may well change during the year.
Okay, we have, let's see if we can squeeze in one more question here. Why have growth stocks recently performed better than value stocks?
Yeah, it's another very good question. Historically, actually, value stocks, which are considered, sort of cheap stocks, have performed better than growth stocks in certain periods. But that's really kind of flipped around in the last few years. Growth stocks have had higher returns, significantly higher returns than value stocks. Now, the reasons could be, low interest rates make it easier to finance growth. You have the dominance, I would say, of the Facebook, Apple, Netflix, Microsoft. Those have really been dominant stocks and have actually benefited during COVID with a stay-at-home, work-at-home environment. And also these stocks, these growth stocks, have been able to consistently generate double-digit growth, and beat analyst estimates. So you just sort of have this momentum in these growth stocks. Value stock, I mean, they're starting to come back a little bit, but they still have a ways to go. Still think it's important for diversification to keep value stocks. Certainly, value stocks can at some point could come back closer to growth, but that's just been the way the market's been. Is that growth stocks have recently done better than value stocks.
Fred, thank you so much for presenting today. Thank our audience for tuning in, and we look forward to the rest of 2021 with some more PENTalks. Thanks, everyone. Have a great day.
Thank you.